Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 417 on March the 5th, 2026. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Fermi Inc., the GraniteShares 2X Long COIN Daily ETF, Petro Brasileiro, and the iShares Silver Trust ETF. And we discuss 4 new trades on UiPath Inc., Red Cat Holdings, the United States Oil ETF, and Occidental Petroleum. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, this week's podcast is being recorded on Thursday evening and will not reflect closing prices on Friday. This show will use closing prices on Thursday, March the 5th. Now, the equity markets are lower so far this week, with the Dow having moved lower than the S&P 500. The Dow Jones Industrial Average is 1,023 points lower, closing on Thursday at 47,954 points. The S&P 500 index has lost 48 points so far this week, closing on Thursday at 6,830 points. Now it's time for the topic of the week. The topic of the week is hesitation. Have you ever hesitated to do something that you really wanted to do and then missed the opportunity altogether? You might kick yourself and, be upset for having hesitated. You might even ask yourself why you hesitated. Still, the fact of the matter is you missed an opportunity that you wanted. That happens in trading all the time for people who lack confidence. So, how do you get from hesitating out of fear and caution to having confidence? For me, it's just math. I always know the risk of any trade I'm entering. I already have well-defined risk parameters that help me decide whether to quickly get on board or not. Now, if the math works out and the chart direction is in order, I'll pull the trigger. If I'm wrong, I'll have other opportunities to exit or trade out of the position. I just don't worry that much about it. Of course, money management is part of this as well. If you're trading too big for your britches, that will also cause you pain. That's another conversation for another day. For now, make sure you're comfortable with the math of option trading. Hopefully, that can help you overcome any hesitation caused by fear when you see a trade that you like and you want to get in. So that's it for the topic of the week. Let's get into the review of last week's trades. We're going to start off with the cover call on Fermi Inc., symbol F as in Foxtrot, R as in Romeo, M as in Mike, I as in India. At the time, the stock was trading for $9.96 per share. I looked at buying stock and selling the March 10 half call at $1.10, hoping for a return of 16.47% in 3 weeks. Well, shares of Fermi dropped $1.38, closing on Thursday at $8.58 per share. The call option that we sold lost 60 cents, leaving us with a net loss of 78 cents if we were to close the trade out immediately. Now, the stock price is almost 30 cents below our break-even point, which means we are well justified to make adjustments. I'll present 2 different possibilities. First, you can roll the strike lower to the 9 strike by buying the $10 strike back and then selling the $9 strike at 75 cents. That would lower your loss on the week to 3 cents and still provide a little bit of upside for you if that stock heads higher to $9 per share. Or you can roll the option to April and collect $1.45 for selling the $9 strike option. You could even simply roll the strike to the $10 strike in April and collect $1.15. That would keep the stock economics the same as the initial trade and allow you to change the loss on the first week to a gain of 37 cents. It would also mean that you're going to own the stock for a bit longer. So it all depends on your appetite for risk and how long you're willing to hold that stock position that just moved against us. All right, next up, we have the cash secured put. I looked at the GraniteShares 2X Long COIN Daily ETF, symbol C as in Charlie, O as in Oscar, N as in November, L as in Lima. At the time, the stock was trading for $7.62 per share. I looked at selling the March 7.5 put at 85 cents, hoping for a return of 11.33% in 3 weeks. Well, shares of CONL jumped $2.56, closing on Thursday at $10.18 per share. The put option that we sold lost 55 cents, assuming we were willing to pay 30 cents to close the trade. At this point, I don't have a reason to close this trade. We sold a put and the stock price jumped higher. I wish that would happen every time, so no adjustments are needed on this one just yet. Next, we have the credit spread on Petro Brazil or Petro Brasileiro, symbol P as in Papa, B as in Bravo, R as in Romeo. At the time, the stock was trading for $16.62 per share. I looked at selling the March 16 put spread at 16 cents. That could give us a maximum possible loss of 34 cents per spread. Well, shares of Petro Brazil grew 12 cents, closing on Thursday at $16.74 per share. The out-of-the-money put spread that we sold is still out of the money. The stock price has not moved enough for us to declare victory fully, but it's moving in the right direction. And for that reason, there's no need to make any changes just yet. We'll see what happens in the coming weeks. For now, no adjustments are needed on this one as well. And I have more to say about that on our final trade, the debit spread on the iShares Silver Trust ETF, symbol S as in Sierra, L as in Lima, V as in Victor. At the time, the stock was trading for $85 per share. I looked at buying the March 84.85 call spread for 65 cents. That could give us a maximum return of 35 cents, or that would have been a 53.85% return in 3 weeks. Well, shares of the Silver ETF fell $10.75, closing on Thursday at $74.25 per share. Who knew starting a war could be so negative on silver prices? But I digress. The in-the-money call spread that we bought is way out of the money at this point. This level of move gives us plenty of reasons to make adjustments before expiration in 2 weeks. I'm still very aware of the fact that this ETF could jump again in the next 2 weeks. Now, our maximum loss on this trade right now without doing anything is 65 cents. Any change we would make needs to lower our risk or increase the likelihood of a profit. Now, we can sell the 83.85 call spread at 27 cents and then turn around and sell the 71.70 put spread at 21 cents. That would allow us to collect 48 cents for selling the iron condor. Now, since we paid 65 cents to initiate the trade, that means we will have paid 17 cents to sell a $1 iron condor. Our total amount of money at risk would then be $1.17. Now, if we make this, of course, we make the adjustment. Now, if we do nothing for now, our total risk is only 65 cents. The math leads me to be a little patient on this one. I expect metal prices to remain volatile during this period, but the math says I should still sit still. So I'm going to stick with the math rather than my desire to find a way to make a little money on this one immediately. Again, I price my trades according to the risk of the trades, so I don't size up on something that I'm not fully aware of, and this trade won't take me out of the game. Hopefully it won't you either if you decided to do something similar. So that's it for the review of last week's trades. We are only 2 weeks away from March expiration, so the shorter amount of time to make an adjustment means that all trades on today's show are inherently riskier. This is the last week that we'll use the March 20th expiration for trades for all monthly options that are trading in the month of March. So that being said, let's talk about the new trades that I'm looking at right now. I'm going to start off with the covered call. Looking at the UiPath Inc., symbol P as in Papa, A as in Alpha, T as in Tango, H as in Hotel. The stock closed on Thursday at $11.55 per share. I'm looking at buying that stock and selling the March 12 call at 89 cents. That can give us a return of 11.6% in 2 weeks. Now you enter this trade by buying stock for $11.55 and selling the March 12 call at 89 cents. This trade makes the most money if stock prices finish above $12 per share. The break-even price on this trade is $10.66 per share. In real terms, the stock purchase will require $1,155, and you'll collect $89 for selling the option. Next up, we have a cash-secured put on Red Cat Holdings, symbol R as in Romeo, C as in Charlie, A as in Alpha, T as in Tango. The stock closed on Thursday at $15.07 per share. I'm looking at selling the March 15 put at $1.50, hoping for a return of 10% in 2 weeks. Now you enter this trade by selling the March 15 put at $1.50. This trade makes the most money if stock prices finish above $15 per share. The break-even price on this trade is $13.50 per share. In real terms, you'll collect $150 for selling the put option, and you will have $1,500 locked up in case you need to purchase the stock. Next, we have our credit spread on the United States Oil ETF, symbol U as in uniform, S as in Sierra, O as in Oscar. The stock closed on Thursday at $96.35 per share. I'm looking at selling the March 95.94 put spread at 40 cents. That could give us a maximum possible loss of 60 cents per spread. Now you enter this trade by selling the March 95 put at $6.20 and concurrently buying the March 94 put for $5.80. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $95 per share. The break-even price on this trade is $94.60 per share. In real terms, you would receive $40 per spread that you sell and have $60 at risk. And then our final trade on today's show is a debit spread. I'm looking at Occidental Petroleum, symbol O as in Oscar, X as in X-ray, Y as in Yankee. The stock closed on Thursday at $53.24 per share. I'm looking at buying the March 52.5, 53 call spread for 32 cents. That can give us a maximum gain of 18 cents, or that would be a 56.25% return in 2 weeks. Now you enter this trade by buying the March 52 half call for $2.09 and concurrently selling the March 53 call at $1.77. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $53 per share. The break-even price on this trade is $52.82 per share. In real terms, you'll pay $32 to enter the spread, and your maximum gain is $18 per spread. That's it for today's show. I had to end it a little bit early because record it early because I'm attending a men's conference this weekend, and there's a good chance that I won't have time to get away to focus on the podcast. Also, thank you for listening last week. I know it was a little weird because I was trying to use a lower voice. I just didn't want to keep any of the guys awake. I was skiing. So if you've listened to the show for any amount of time, you'll know that I really do love skiing. So I love it even when I get a little banged up, which I did last week. But that's neither here nor there. I feel good today. Wanted to get this show out for you guys on a Thursday night. So enjoy the early show and have a wonderful weekend. As always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.